Thank you.
Good afternoon, everyone, and welcome to the Financial Planning Faculty Study Group presentation. And this afternoon, we're having a discussion on the benefits of the Section 1202 under the Internal Revenue Code, the so-called qualified small business stock. Is anyone familiar with this section or has worked in this area before?
I would suggest that you go through it because I think this particular topic is somewhat not very usual for people to work with. So if you don't mind to go through it, that might be helpful.
Sure. Let's spend just a second on the agenda. So I've laid out the presentation. I prepared a presentation. I have about 13 slides here, but I want it to be interactive. So if anybody has any questions, comments, etc., feel free to interrupt me at any point in time. So the agenda here, I have the purpose, I have some general summary points, historical background of how this Section 1202 benefit came about, the requirements that would allow taxpayers to get this benefit, and it is a huge benefit to taxpayers. And there's two sets of requirements. So there's a requirement at issuance that we'll get into, and there's also a requirement during the holding period. The impact on 1202 of the new Tax Act, there's some sister provisions that would be helpful when applied in conjunction with the 1202, and I have a couple of examples as well. So what is the purpose of Section 1202? The purpose is to spur investments in smaller and startup type businesses. Congress in the early 90s thought that small businesses needed a boost in capital, and they came up with this Section 1202 benefit to encourage that investment and participation. From a big picture standpoint, and I'm going to get into a lot of tax legal detail here because it's very rule oriented, but let me give you the big picture so you can keep that in the back of your mind. And if you're working on any projects or if anything comes up in this area, you can use this as your, I guess, one line or one sentence summary. This is the benefit that's provided under Section 1202. If you buy a stock in a domestic corporation, and if you hold it for 5 years, and then sell it at a gain, the gain is not taxable. Okay, let me repeat that. You have an investment in a corporation that has appreciated in value and you sell it for a gain, the gain is not taxable. So what are some of the highlights that allow a taxpayer to get this benefit? First, the position has to be sold at a gain. The next, which is by far the most important, it has to be qualified small business stock. And I'll get into the requirements of this in the slide, 2 slides after this one. The stock has to be held for a minimum of 5 years. And the exclusion amount currently is at 100%, so the entire gain is excluded. But earlier, when the provision came about, only 50% of the gain was excluded. And I'll get into the periods of time where the exclusion was up to 50% only, and then it went up to 75% for a short period of time. And then since 2010, it's at 100%. The stock, the investment, has to be a domestic C corporation. So it can't be a foreign entity, it cannot be a partnership, and it cannot be an S corporation. And that's one of the reasons why, one of the few reasons why this provision has not been popular and used by most taxpayers. Another requirement is that the operations of the entity of the corporation has to be a qualified active business. And there's two provisions, two requirements underneath this qualified active business requirement that I'll get into in a few slides. And there's some gross asset tests. After the investment is made, this qualified active business has to satisfy these two gross asset tests. There is a cap on the exclusion amount. So it's not millions and millions of dollars. And this is the cap, and it's in the statute. And this cap is per taxpayer per investment. So, for example, if an individual makes investments in two separate enterprises, two different enterprises, two different corporations, this cap applies to each one separately. It's not combined, but it is cumulative as to one specific investment and that taxpayer who made that investment in that entity. So this is the cap. It's 10 million cumulative over the life of that investment in that enterprise, in that corporation. The greater of 10 million or 10 times the adjusted basis of the investment. And here I have a maximum of 50 million, which in very limited circumstances, I guess it is conceivable that somebody could get to that level, but for the most part, the lion's share of the investments and the limitation is going to be at that 10 million. Any questions so far? Am I going too fast?
So no, you're doing fine. So the key word that I learned from this slide is it has to be a gain. If there's a loss, then this doesn't work, right? So that's your number one rule there.
Correct.
Okay. Thank you.
The opportunity zones are separate. They're under a different code section. It's code section 1400. But they do work hand in hand with this provision. So a combination of opportunity zones and section 1202 will turbocharge the benefit under IRC section 1202. And I will get into that in my second to last, right before the examples. Go ahead, Chia.
So would you say that because of the opportunity zone investment became somewhat of a popular, then section 1202 has also gained some traction? Because over the last several decades, there's really very few companies actually took advantage of this. And you know, the word on the street is because of the opportunity zone investment kind of bring this kind of section back to life.
Yes. Yes. There's some other provisions also, but that is one of them that made 1202 front and center. So let's look at the historical background and discuss why it wasn't very popular. So this came about in 1993 during the Clinton administration. Originally, the exclusion was 50%. So if you had gain, you could only exclude 50% of the gain. And that was effective beginning on August 10th of 93, all the way up to early 2009. And they included a provision in the code which said that if you include 50% of the gain, exclude 50% of the gain, the remaining 50% that is included will be taxed at 28%. So for example, if you had $100,000 gain, you could exclude 50,000, but the other 50 would be taxed at 28%, making the effective rate on the entire 100,000 at 14%. Remember, at the time, capital gains were being taxed at 28%. In 1998, the capital gains rate was reduced to 20%. However, the 1202 exclusion and the tax rate on the non-excluded portion remained at 28%. So what happened was you were getting a 14% benefit, but the entire gain would be taxed at 20%, so your savings was only 6% instead of 14% originally. And in 2003 was the final blow, which really made this 1202 almost obsolete, is when capital gains rates went down to 15%.
Could I ask a question?
Go ahead.
Yeah, the 1202 applies only, this is Igor Zay, that
Hi.
1202 applies only to the federal, right?
Correct.
What about the state? Because it's, let's say, California, that's 10 plus. Is that also?
California. California had a provision, had a similar provision, but that expired in 2015. So for California purposes, there's no benefit at this point in time.
So you have whatever, okay, so you have a full exclusion, but you still pay the California capital gain.
Correct. Now, one thing that might work, Igor, is if the purchase was made before 2015,
Well,
California may allow for that benefit. I'm not sure. But I know for all the purchases after 2015, there's no California benefit because 1202 for California purposes has expired.
okay, and this does not have to be a public corporation, right? Publicly traded, it can be a private corporation, as long as it's...
Correct.
There's no bar of it being a public entity, but as you will see in the next slide, the benefit is focused on small or smaller type entities based on the capitalization of the entity.
I see.
So hold your thought for just a couple of minutes and we'll get into it on the next slide.
I thought there's one more thing, Igor, to keep in mind is that oftentimes this also can be used as a deferral purposes. So I think it's coming up in your other slides. Sometimes it's not just to exclude the gain. Sometimes it's that you do know that there's a gain, but if you exchange it for something else, you can further defer that. So there's something about deferral strategy here as well.
Yeah, I'm going to get into it on the second from the last slide under other favorable provisions, the other sister provisions to this. So because of the adjustment in the capital gains rate in 2003 and the fact that very few people were using this 1202 provisions, in 2009, Congress bumped up the exclusion. Oh, we lost Igor. Congress bumped up the exclusion to 75% of the gain, and that was for a very short period of time, as you see from February of 2009 until about September of 2010. In 2010, I said, okay, we need to really enhance and spur investment in small and startup businesses, so they bumped up the exclusion up to 100%. And one point that I want to make here is the date of acquisition of the shares, depending on when they were acquired, after 1993, the period of time determines the exclusion amount. So for example, if you have an investor who acquired shares in 1998, for example, they would get the 50% benefit, even if they sold their shares today. For somebody who bought their shares in late 2009, they would get the 75% exclusion. So to get the 100% exclusion, the shares have to have been purchased after September 28th of 2010. In 2015, and this was temporary, it was every year Congress was extending it, like some of the other provisions, some of the other expiring provisions that we have, Congress was extending it. And in 2015, it was made permanent, retroactive to 1/1 of 2004. The reason why this was not popular is, one is the reduction in capital gains rate, making the benefits smaller and smaller every year. The other is the requirement that the investment be a C corporation. And C corporations have this problem with double taxation. So we have the income tax that's paid at the entity level by the corporation, and the shareholders, when dividends are paid out to the shareholders pay income taxes on that dividend. So this double taxation feature is the second reason why Section 1202 was not popular, where small and startup companies were focusing and choosing an S corporation as their entity of choice to avoid the double taxation, and also as LLCs, limited liability companies, became more and more popular, more and more in favor by accountants and lawyers because of their flexibility, because of their legal and tax flexibility. Most of the startup entities were being formed as S corps and or LLCs. And as a result of this unused, shall we say, of Section 1202, there has been very little guidance from the IRS and very few court cases to provide background and analysis. So there are some big areas where the rules are not very clear and they're subject to interpretation, and we don't know how the IRS might rule or might decide if an entity or if a taxpayer decides to take advantage of a 1202 benefit. Yes.
So question is that I think that the maybe you'll get into in the interpretation in a little bit. If I recall correctly, that if you follow all the rule, let's say if you invest in a small corporation in 2010, you have the gain increased to 100%. However, that small corporation was not initially set up as a C corp. So let's say if they initially set up as LLC, and then somehow, somewhere elected to become a C corp in the life of the corporation, I think there was a problem there. It has to be initially founded as a C corporation to go into it. I think that was one of the interpretation that the IRS is still not quite clear on that. I don't know the answer, but I'm just kind of let you know, I think that there is some interpretation issue there.
Yes, that's correct. So here are the requirements at the time of issuance of the shares or at the time of purchase. So the corporation has to be C Corp since inception or since August of 1993. So it was an S Corp at some point and then converted into a C Corp. That wouldn't work. It has to be a C Corp at all times. The other requirement is this qualified small business requirement, where the assets within the entity within the corporation have to be less than or equal to 50 million right after the issuance of the shares. So if we have a couple of investors, let's say an investor and an operator form an entity, and each one of them put in $1 million, we have $2 million, there's not a problem because we're not even close to 50 million. But if at some point in the future the company, the operations take off and they need more seed capital, and they go out in the marketplace and do some fundraising and sell additional shares, if at any point in time the gross assets go above 50 million, then the company, the shares can never be Section 1202 shares because it can never qualify as a small business. However, the original investors, in my example, those two individuals that formed the entity and put in the $1 million each, those two individuals would be protected if years down the line, 5 or 10 or 15 years later, there was a need for additional capital and the gross assets go above 50 million. Future subscribers, future purchasers could not get Section 1202 benefit, but the original investors, the original contributors would be able to get Section 1202 benefit.
Okay, so I guess the keyword, the key issue here is the gross assets less or equal to $50 million at all times, right?
Yes.
So if it's forget about the assuming that everything is original issuance, but if at all time, any given time that gross assets gone over 50 million, that would disqualify the entire Section 1202. Is that correct? Or
Forever.
only forever?
Forever.
That's right. Okay. Yeah.
And for future subscribers.
Right.
Yeah.
And the assets here is defined as cash and adjusted basis of the assets. So that means that it is very likely, let's say if I go form a company, I contribute a real asset into it, that could consider it to be an asset. Or I could also contribute intellectual properties into the company as an asset. And typically intellectual properties potentially are a lot smaller from assets perspective. Am I interpreting that correctly?
Yes. So let me give you an example. Let's say somebody forms a corporation and contributes 2 items to it, $100,000 in cash and a patent that has a fair market value of $900,000. So effectively, this individual contributes $1 million into a corporation. But his cost basis, his adjusted basis in that patent is very low. If it's a self-created patent, it could be close to 0. For this test, for the gross asset test, we take the cash of 100,000 and the adjusted basis of that patent, which for all intents and purposes is 0. So even though in terms of value, the corporation has about $1 million in it, for purposes of gross assets, this test, it only has about $100,000 in it.
Right. So effectively, that if it's something like intellectual properties, is probably more favorable in considering this type of take advantage of this. But the other question that I have is in terms of assets, right? What if I contribute? So real assets is interesting. Real assets is pretty straightforward. But what if I contribute a company? A company is an asset as well, right? What if I contribute an entire corporation as an asset?
That works, but there's additional requirements during the holding period.
Right, right.
And that those rules have to qualify. So in your example, you're saying, okay, what if I contribute some shares of stock of another enterprise or some LLC interests? For
Correct.
purposes of this test, you would look at the cost basis of
Right.
that asset in your hands for purposes of this test. But if you
Right.
look at the last bullet point, special basis rules, that is a different rule that will come into play. But for purposes of the gross asset test, if you contribute shares of stock that has appreciated in value with a low cost basis, the cost basis would be calculated in determining this less than or equal to $50
Correct.
million asset, not
Correct.
the
So
value.
let me walk you through an example. This
Mhm.
might bring up some discussion here. So let's say that I have a company that I know the cost basis is less than $50 million.
Okay.
So the company was formed a long time ago, not a C corporation. And I later learned about this wonderful things going on. And I know the company is going to be appreciated a lot more than what I currently have. So then I created a C corporation right around 2015, right? Whatever the deadline, 2010, right? Create a C corporation and then use the idea of, let's say, merger and acquisition. So the C corporation is a different business, but somewhat relevant business. And then I contribute this particular company, let's say it's an LLC, into this C corporation, which adjusted basis of the assets still qualify. But then that effectively, logically, effectively wouldn't have turned that C corporation, it will turn into assets of this particular C corporation. Would that still qualify?
Not for the, if you look at the last bullet point, special basis rules to prevent big conversion,
Okay.
it would
Well, the
qualify.
question will be big. How big
It
is
would
big?
qualify because for the shareholder, there's an anti-abuse rule built in this, which is the
Okay.
following.
I see. Okay, good.
So if you have low basis, high value asset that is contributed into an entity, for the 50 million test, you calculate the 50 million, and now the calculation is based on the adjusted basis, which is the low basis. However, for purposes of calculating the 1202 gain on sale, you calculate it at the fair market value on the date the asset is contributed into the entity. So we have
Yeah.
kind of two separate calculations that are happening.
Correct.
One within the entity and one outside of the entity to calculate the gain or loss upon sale.
Right. So even if that for sure that that company is going to be appreciating a lot, but at the moment of the transfer, it's still, the fair market value is still not there yet. So, but anyway, so I understand the prevention of big conversion here.
So any future appreciation would qualify after the contribution. If the stock appreciates after the contribution, that may qualify for section 2, but not the appreciation that happened before it was contributed into the entity.
Okay.
Yeah.
Thank you.
Sure. And then so we covered that special basis issue, and then the issuance date is important because the period of time determines the exclusion amount. And that's important to determine whether the exclusion of 50, 75, or 100%. Now here's the more complicated analysis and computations, because these happen within the entity. This analysis is done at the entity level, within the entity itself. So the entity must be a C Corp for substantially all of the holding period. And what is the holding period? It's that 5-year period, or it's the period of time before the sale. And I'll get into the substantially all analysis in just a moment here. So that's one item, one of the requirements. The entity must be a C Corp for substantially all of the holding period. And the operations of the entity must be an active business for substantially all of the holding period. And in the previous example where we're contributing a corporation or a business enterprise into a corporation, that would work if that entity's operations would qualify as an active business. And there's provision of what an active business is. There's two requirements for an active business. The entity has to be an eligible corporation. This one is fairly easy. Eligible corporation, our corporation is a corporation that is not a DISC, a former DISC, a RIC, a REIT, a REMIC, or a co-op. Okay? So if it's none of these entities, a DISC is a domestic international sales corporation, a RIC is a registered investment company, a REIT is a real estate investment trust, a REMIC is a real estate mortgage investment conduit or cooperative. So if it's none of these entity types, and those are special elections that entities have to make at the time of formation, it would work. So it must be eligible, i.e. not one of these special entities. And then the operations have to be a qualified trader business, And there's a tie-in here to the 199A specified trader businesses here. And although the list under 1202 is a little bit bigger, and I'll go over some of them here. So what are we looking at? What it does not qualify as a trader business for purposes of 1202 is lawyers, accountants, doctors, chiropractors, engineers, architects, the individuals that require a professional license and are providing professional services. Also, banking and financial services don't qualify. Farming doesn't qualify. Oil and gas doesn't qualify. Operation of a hotel or a motel does not qualify. There are two areas that there is some guidance on by the IRS. One entity that was providing consulting services for drug medication, doing research and development on medication, and the IRS said that that was okay. That was not a providing of medical or health services, or at least those types of services were okay for purposes of 1202. In other words, they were a qualified trader business. Another one was a large insurance brokerage with about 400 employees, 150 employees and 250 agents. And the IRS said that was okay as well. Now, one area that is not a qualified trader business is when the primary reason of the operations of the business is the reputation and knowledge of an individual. And the IRS, in the case of this insurance broker, it said that even though the owners, the two or three individual owners, had a reputation in the community, that was not a reason to disqualify them from Section 1202, because they had an operation of 400 employees and independent contractors, and the reputation of one or two or three individuals was not enough to counteract and prevent this entity for getting the 1202 benefit. So what does that leave us with? What type of businesses qualify? Manufacturing, retail and wholesale operations, tech.
Probably, and did you mention engineering?
Yes.
So
Yes,
engineering, I would assume this tax law is encouraging innovations.
Exactly.
So it could be innovating, consulting part of drugs creations, and potentially just to encourage more innovation in the country.
Right. I agree. I think that was the goal. And then it's evolved over the last 20, 25 years, since the tech field has mushroomed and is exploding. A lot of the software development, manufacturing of electronic equipment, all of that would qualify for purposes of 1202. There's some other very tricky rules here that could create problems for entities. More than 80% of the gross assets have to be used in the qualifying trade or business. More than 80% of the assets. So the patent, for example, in our previous example, the patent that was contributed into the entity has to be used in the operations, whether it's generating royalties for the company or it's being used in other factors that would qualify if it's used in the trade or business, rather than as an investment, being held by the business as an investment. So what type of other activities would qualify? Startup activities, research and development, internal research, and pre-formation expenses qualify. The goal here is Congress, when they put this rule together, they wanted these startup businesses who want to qualify for 1202 to start spending money as soon as possible. Now, in this case, and this would probably be the case if the entity has been around for quite some time, if there's internal created goodwill. In the previous issuance, internal created goodwill, because we were looking at the adjusted basis, probably would not factor in. But here, for purposes of the 80%, any internal created goodwill most likely would have to be computed and included in the 80% test. And that requires, as you probably know, some type of evaluation.
Right.
Working capital reasonably needed by the operations for one operating cycle. In other words, the period of time that a company goes from the start until completion, whether it's manufacturing an item, as an example, from getting the raw materials, the work in process inventory, selling it, billing and collection, that cycle. For one cycle, reasonably necessary working capital is allowed and included in the 80% test, but only for the first 2 years of formation. After that, working capital is limited to 50% of the gross assets. And then more than 10% cannot be held in investment real estate. But if the real estate, if it's a research lab, for example, if the real estate is owned by the corporation as being used as a research lab, that would be okay, and that would be included in the 80%. But if it's an asset being held purely for investment purposes, and it's not being used in the operation, it wouldn't be included. Same with investment securities that are being held for investment purposes. Then for the substantially all, remember this substantially all has to apply to both the first and the second bullet points. The entity has to be a C Corp for substantially all of the holding period for the shareholder, and then the operations must be active for substantially all of the holding period as well. So what does substantially all mean? Substantially all, in my opinion, means something less than 100%. But how much less is the key question. Is it 90%, 95%, 85%, 80%? There's a case where there's under another code section where there was an analysis done by the court, and the court said over 86% or higher was substantially all. And if we use that case and analogize to the substantially all under the section 1202 rules, if 86% of the period of time the entity is a C Corp, then it would qualify. If more than 86% of the time the entity was conducting was an active business, or in other words, was operating a qualified trade or business, then it would be okay. I would venture to guess that if we went down a little bit lower to 80%, that would be defensible as well, but not below that. So something at 60 or 65 or 70% or 75% would be easily challenged.
And that percentage is measuring the gross assets.
No, that is measuring the substantially all.
Meaning the holding period.
Meaning the entity has to be a C Corp.
C corporation, yeah.
For 86% of the time.
Right.
Of that holding period. And also that's one. And then the other one is 86% of the time or more, the entity operated a qualified trade or business during this period of time.
So can I walk through an example? Make sure that I totally understand. So let's say this company I buy the workplace clothes from, they basically make they're specialized for women clothes. And the materials is basically your yoga pants material. And they make that into stylish office, dress or pants and stuff like that. So let's assume that they put $10 million into the company, which is their gross assets. Let's just assume it's cash. 50% of that, or less than 50% of that, can be used as working capital, right, for the 2 years period of time, where they design the clothes and then they potentially outsource the manufacturing of it, and then they sell them. So the working capital will be, let's say, 50% of that money. But they could also at the same time contribute a building into the C corporation, knowing that they will be operating from that particular real estate. And this real estate that the way they contribute is that they actually borrow money to buy that piece of real estate. And so the down payment, effectively the down payment of that real estate has to be less than 10% of the gross assets. Am I logically thinking that correctly?
Because the building is going to be used in the operations.
Correct. Yeah.
You don't have to worry about the 10% rule.
I see. Okay. So because it's going to be using in there, so it doesn't have to be following that 10% rule. Exactly. So then I could acquire that real estate. Not at the very beginning is probably I could acquire that maybe second year once the business is going well.
Yes.
And because it's the investment of the securities, so I don't have enough cash, so I'm going to use my existing securities as part of the investment to make up the gross assets. Given the fact that the business need to borrow money for working capital, those could be leveraged as a collateral inside a corporation to qualify potential borrowing of a working capital. So all of those examples could be part of either initial or part of the establishment of the corporation as well.
Yes, let me clarify a couple of points. The working capital cannot be too high of an amount.
Correct.
Number one. Number two is if it's a corporation, the recommendation would be, because we have a corporation here, the recommendation is not to put any real estate in a corporation, but rather have the investors and the shareholders
Got it.
buy the real estate outside of the entity in
Correct.
in another, most likely a partnership or a limited liability company, and then lease it to the corporation.
Yeah.
And
Yeah.
and the corporation would use that property in its operating business.
Correct.
And the rental expense being paid out every month by the corporation would use up some of this cash and help with using the cash, and so that there's not a lot of cash sitting on the balance sheet of the entity.
Correct. Yeah. Yeah.
That's the big risk. That's the big risk is having too much cash lying around and not being used.
Right. So this particular company I'm talking about, they're quite smart in terms of how they set it up. Is that they every single product that they introduced, they
Yes.
use the concept of like a GoFundMe type of concept. So they
Yes.
will put their design right on their website, and then they will ask people to provide feedback. So for example, typical yoga pants doesn't have pockets. So for a lot of women, then you can't put your cell phone. So because of the recommendation of their consumers, so they put the design up on their website, and they don't go on sale right away. What they will do is that if we have number of you as a consumer sign up to pre-purchase the product, then we will go make it, and then we will ship your product for 6 months. So that is very smart. So they are not necessarily borrowing a lot of capital for the working capital because it's already pre-purchased. And so a lot of those companies today are quite smart in terms of how to structure their business to their advantage for operation purposes.
Yeah, it seems like it's an improved or sophisticated way of using the just-in-time inventory system.
Correct. Yeah. Yeah. It's crazy. You know, we women have to buy clothes, and then I actually waited for 6 months for a skirt. And skirt is a combination of skirt and pants, and they're all made of yoga material.
Right.
And so it's extremely comfortable and stylish in the office. But that's how they get around with not using too much of a working capital. So I thought it was a very smart design.
Yeah. Now, however, though, at that point, if they have cash lying around that they're not using, but after 2 years, that working capital will only go against 50% of the gross assets.
Correct. Correct.
So if they have too much cash, then that might be a problem.
Right.
Yeah. So the reason why 1202 has become a lot more popular now is because under the new Tax Act, the corporate tax rate went from a high of 35% to a flat tax of 21%. So even though corporations still have the double tax problem, it's a lot tempered than what it was before the 2018. And this is one of the reasons why 1202 is kind of getting more traction and has become more interesting for operators and for investors. The other option, the other component too, is that corporations can retain their earnings and not pay the dividends. By doing that, they can avoid or delay some of that double tax problem. The other two things to note in a 1202 context is if the client or the individuals approach an accountant or an attorney ahead of time, there could be some diligence and some pre-formation planning to set things up. Now, these rules, the requirements at issuance is at the time the stock is issued. However, the requirements for the holding period have to be done regularly during the operation of the company. And one commentator was recommending doing this analysis, this 80%, 50%, 10% analysis on an annual basis. It could be done on a semi-annual basis, or if somebody's really aggressive, it could be done on a quarterly basis so that the company can adjust quickly if they're getting close to breaking some of these thresholds.
So do you mean that they need to conduct some sort of formal appraisal, so then these numbers has been checked on a regular basis?
Yes, yes. Even if it's not formal, then for sure an analysis so that to see where they fall within this 80% and the 50% and the 10%, and making sure that the working capital is not high, is not too high.
Okay. So really, in reality, is that if someone wants to really take advantage of this from the start of the formation, other than working with the attorney, of proactively pre-formation planning, you also need to have a good CPA firm, giving you guidance on the valuation along the way. So then you keep track of what you're making sure that you stay below that threshold.
Absolutely. Because that's going to be critical, since these rules have to be met for substantially all of the holding period. Otherwise, the stock fails this 1202 provisions, and the shareholder, the seller, cannot get the benefit.
So really, for people to take advantage of this, not only you have to have proper planning, continue to monitor, you have to really, really be proactive on it.
Absolutely. The other way to do it is, in your example, the yoga pants manufacturing company, for example, if they did not think about this at some point early on, they could do retroactive analysis. For example, if the company is around for a few years, so long as it's a C Corp, a domestic C corporation, an analysis can be done if the company is not big, or is within, as if it's less than 50 million, an analysis can be done retroactively to see if they fall within these 80%, the gross asset test rules.
Okay.
Here's some sister provisions. The rolling over that you were thinking about earlier in the presentation is under section 1045. So 1202 allows the exclusion of the gain. 1045 allows a rollover of the gain. And here, the holding period is only 6 months. Only 6 months. So
you mean for 6 months of holding, once you sold the property, sold the company, you have 6 months to get to exchange into something else. Is that correct?
No, that's under that's the opportunity zone rule.
Okay, all right. So
section 1245 works more like a section 1031.
Correct. Okay.
The holding period is the holding period of the shares. So if an investor, or if an original purchaser who bought the shares from a corporation holds a share for 6 months, they can roll over that gain, and they can sell it, but they have 60 days to acquire a new QSBS.
Correct. So I think that what in the past, what my clients have done was that for using 1045 to roll over to another QSBS, some investment company has the equivalent QSBS type of security that they can actually purchase as a 1045. So they are investment available specifically designed to roll over a gain like that.
Yes, the entity that they're rolling over into must be a QSBS.
Correct.
In other words, these rules, these requirements at issuance and for the holding period have to.
Right.
There's also another beneficial provision, section 1244. It's very minor, and for that reason, it's not used it's rarely used. The benefit is the following. And it's a little bit different. It's not a QSBS, but it's the acronym is an SBS, a small business stock. And here, if a small business stock is sold for a loss, this section allows the conversion of that capital loss to ordinary loss, but only up to 50,000 or 100,000 for married filing joint taxpayers. So up to 50,000 or 100,000 of a capital loss could be converted to ordinary loss. Since the amount is so small, then a lot of pre-planning to fit into 1244 is most likely not beneficial or efficient.
Right.
And then there's section the 1400, the opportunity zones. And the opportunity zones have a longer period of time where the gain could be rolled over. It's 180 days. There's a 15% initial gain exclusion, but to get the entire 15%, the investment has to be made by the end of this year, by the end of December. Otherwise, that 10% goes away, so the only 5% could be excluded. They have to be holding the asset, the enterprise for 7 years to get the benefit. And after the rolled over gain is included in 2025, any future appreciation is excluded. But if 1400 could be combined with 1202, in other words, if the entity is a C corporation that the gain is being rolled over into, then it's possible to get the 1202 benefit and the opportunity zone benefits together. However, opportunity zone does not have to be a corporation. It could be a business, it could be a partnership or a limited liability company, it could be a sole proprietorship, and it could also be a corporation. But in order to get the 1202 benefit, the opportunity zone fund has to be formed as a C corporation.
Well, I think that maybe in the future that we can talk about opportunity zone fund. There is a lot of interest, but so far the opportunity zone hasn't been performing as well as expected. So maybe at some point we can talk about the section 1400Z.
Yeah, the main concern that I have with opportunity zones is how well the investment or the business is going to perform. Yeah. That's the most challenging aspect.
So most of the opportunity zone, I won't take too much time here, but I think that most of the opportunity zone are predominantly real estate based. So that may potentially not qualify for the 1202. But if it's not, then, if you have manufacturing business like the one that I talked about, happen to be operating in that opportunity zone, then that will be pretty good combination.
Yes. And the other thing too is real estate. That's one. The other one that is excluded from 1202 are the operating a hotel or a motel.
Correct.
There's also another
real estate,
investment in an opportunity zone that a lot of firms are looking in.
Correct.
We're over our hour, but let's just spend just a minute on an example. Here's an example that would give you an idea of how this this 1202 works, assuming all of the other provisions are satisfied. So if we have Luther purchases 10,000 shares in Kalu directly from the company and pays $100,000 for it. And in 2019, he sells it for 24 million. What is the gain and how much of the gain is excluded? So the gain is going to be, as you see in the first item there, 23.9 million. And for Section 1202 purposes, since he acquired it, if he acquired it before 2009, the exclusion is only 50%. So we have the ceiling, it's 10 million or 10 times the basis. So what's his basis? 100,000. So it's the higher of 10 million or 1 million. And here's the calculation. So our gain is 23.1 million. We can exclude 50%. The limitation is 10 million or 1 million. He can exclude 10 million and get a 50% exclusion of the 10 million. So he can, under 1202, he can exclude 5 million. So his entire gain is 23.9. The 1202 exclusion is 5. Remember the balance, 10 million minus 5 million, the other 5 million has to be taxed at 28%. And then the remainder, the 13.9 million, is taxed at 20% at the capital gains rates in 2019. So he was able to get some type of a benefit here. And of course, let's not forget about the AMT adjustment. Where this makes, and I'll jump over to the 100% example. This is where it makes the most sense since the rules were changed. If we can exclude 100% of the gain, the entire 10 million is excluded. Nothing is taxed at 28%. So 10 million is excluded. He only pays tax on 13.9 million at 20%. Of course, state taxes would apply to this if the state in which Luther lives does not have a corresponding provision that gives him the 1202 benefit, and there's no AMT adjustment.
But so 10 million is excluded, the 13.9 million could roll over. Is it possible? Can you roll over the gain? So the 10 million is excluded, so I don't have to pay taxes on 10. Could I then roll over the 13.9, however much that I could? I don't know if that's possible or not.
Yes, it is possible, but the way that it would have to be set up is the following. The sale has to be split into two components.
Got it, right.
One would be sold at 10 million.
10 million, right. And the other one sold at 13.9.
13.9, and then that gain would be rolled over and the 10
over.
Included.
Yeah.
That's how.
So basically, it's probably basically an installment sale for two transactions.
Yeah, well, or splitting it up into two transactions.
Two transactions.
Split up into two transactions, it would work.
Correct.
Yeah.
Or in this case, we're talking about just one taxpayer acquired 10,000 share, unless it's two taxpayers, and that's a different story. Yeah.
Correct. Correct. Yeah, and if this individual sold half the shares in 2019 and the other half in 2020, for example, in 2020, he will be able to exclude 1 million only, because right. He used up his 10 million in 2009.
Got it. So I would assume, based on this particular scenario that you have, should have encouraged a lot of angel investors.
Yes.
Right, because most of these are most angel investors are looking for, high potential innovative type of products or services. And so this would have been a very, very good encouragement if the company was pre-planned properly, and has a good idea. So if the innovation has a good potential going forward, then angel investor probably will be a lot more favorable in terms of investing, such as part of the qualified companies that you had mentioned didn't include such a company, such as gaming company. So a lot of the smaller gaming company, they can design the software. They can effectively, they don't have to be a big player software. They could be a subcontractor, a big player of doing nothing more, but then doing the artistic designs or programming and stuff like that. That could have been a very beneficial type of angel investing.
I agree. And the other benefit too that is helpful in your in the fact pattern that you just described is that partnership or LLCs can invest and get these shares.
That's correct.
It's not limited. It's not restricted to individuals only.
Correct.
Yeah.
Correct.
You cannot get the
holder of the shares could be another entity. Yeah.
Yes. Yeah. An S corp, for example, even though it wouldn't qualify as 1202, an S corp itself or a partnership or an LLC can buy a 1202 shares of stock. That's not prohibited.
That's right.
Yeah.
Right. That's right. All right. This has been really, really informative.
Yeah, I'm glad you enjoyed it.
Yeah, it's lots of. I believe that this type of presentation can be presented again if you are interested. The Hub 101 has angel investors group, and this could be a concept introduced to the Hub 101 as all these high-tech startup company are forming and thinking about how they should structure their company, and having that concept in there could be a very good selling factor when they're out there pitching investors opportunities.
Okay, yeah, that's an excellent idea.
Yeah, yeah. Well, thank you so much. I know that we've gone 10 minutes over, and this is a great session.
Yeah.
And we'll do an email exchange as far as when is the next one going to be, and then what will be a next appropriate topic. If there are any particular topic that you want to talk about, we can discuss that as well. But I like that opportunity zone topic. I think it's a question that a lot of people ask, and it doesn't seem to have a lot of guidance yet.
Yes.
Yeah, so hopefully we are coming down to the end of the fall. You, depending on your timeline, because I know you're going to be busy.
Yeah,
with the tax season.
Let me finish the. Let me end the recording.